Hello, everybody, and welcome to the Tortoise channel. Happy to have you join us. And today we will be covering the three stocks that I would love to buy in the next market downturn. I'm not a market forecaster, unfortunately, so I don't know what the market will be doing throughout this year, next year, or thereafter. But what I do know is that I have a number of great companies on my watch list, which I've already made available to you guys. Just to go back to one of my previous videos, and you can see the companies that fall into that watch list. And these are the three companies that I would love to buy. Okay, but the thing is, they meet the quality for criteria, or at least most of the things that I will be looking for in a company, but price is what you pay, value is what you get, and I still don't have my margin of safety. But before I delve deeper into today's video, I just want to say big shout out to one of our subscribers and also clients, Lucy. And you can see, I had to share this with our community here. But man, I was so happy because Lucy was buying healthcare. I even shared this. By the way, if you guys don't know, we have a free WhatsApp group here. We have about 38 members in that group. Many of the members that have been joining recently, since we created this group, you've come from YouTube, so it's nice to have you join us. But I shared this morning. Big shout out to Lucy Mattison, who invested in Novo Nordisk, a healthcare giant, after the stock collapsed 70% from its all-time high in June 24. So Lucy and I worked on this case together, and the company's undergoing significant restructuring, including leadership changes and job cuts. They are aimed at improving the company's operational efficiency. And sure enough, they crashed big time. But the reality is that the company remains a global leader in diabetes care, operating in a duopoly with Eli Lilly, and continues to hold a strong market position. So despite increased competition, the reality is that both Lucy and I agree that the fundamentals remain robust with expanding margins and consistent revenue growth. So she continued to load up the truck, and sure enough, she made it our largest portfolio holding. And it seems like she even got the bottom of this stock. I mean, just let me share eToro right here. As you probably know, if you have been following this channel, we always use eToro for educational purposes because it's more user friendly. But look at that. I mean, she literally caught the bottom. Our approach, as you guys know, is 90% fundamentals and 10% technicals. So Lucy and I already agreed that we had a great company in our hands. On our hands, so a great company, great fundamentals, and price really got detached from the company's fundamentals. This is the perfect setup for us, Tortoise style investors. So I looked at the chart, and you can see that where we were aiming to start buying really coincided with this strong line of support right here. And sure enough, it seems that this thing is just going up because it coincided with a series of positive news coming out of the company, namely some leadership changes, and the fact that one of the drugs got great results lately. Okay, I'm not sure exactly which drug was it. Lucy, of course, is more into this because she made it a portfolio holding, and I always advocate for understanding the businesses that you own, of course. But yeah, so I'm very happy. By the way, no guarantees that the stock is not going to roll over. But what we do know is that we have a great company and that we buy it with a margin of safety. And guys, I keep pounding the table on this. You don't need to chase the shiny object in order to make a lot of money. It's exactly the opposite. If you really want to make a lot of money sustainably over time, what you need to do is you need to find setups like this one. Find a great company, number 1, 2, 3 in the respective industry, that is temporarily hit by a series of headwinds that cast a lot of doubt on the company's outlook. And provided the fundamentals don't change, and the story remains, the story still stands. This is what's going to allow you to make a lot of money. And sure enough, we had improving margins, growing revenue, so the fundamentals were improving while price was going down. I love it, and so does Lucy. So big shout out to you, Lucy, if you are watching this video. Okay, guys, now on to today's video. These are, like I said, are some of the companies that I would love to buy in the next market downturn. And as always, if you like what we are about to cover, please make sure you smash the like button and share this video with people that you know who might benefit from what we are doing here. The goal is to create a lot of value for our viewers, and that's it. And we are all walking along the same journey. Okay, so company number one, Domino's Pizza. Who doesn't like Domino's? I mean, I love Domino's Pizza. I just love the product. Not that I like to indulge in cheat meals on an ongoing basis. In fact, I'm quite healthy and I like to go to the gym and follow a healthy lifestyle. That said, I really like Domino's Pizza. So whenever my girlfriend is telling me, "Hey, should we order pizza? Let's go with Domino's." Very good. But now let's talk about the business. Okay, so we like the product, but does that make it a good business? Liking the product, as you know, is very good because it means it has a meaning to us, and that's our first ham. Do I buy the products or services? In this case, it's pizza, so it's a product. That's one thing. But now we have to go to the second M, and that is, in fact, still in the first M, you have to understand how the business makes money. So do you understand how the company makes money? The geographic split, how they operate, and then we ask about the competitive advantage of the company. Okay, if the company has a moat, and then we ask about management. Do I like management? Do they have skin in the game? Okay, how long has the CEO been at the helm of the company? And last but not least, yeah, we want to buy it only with our margin of safety. Okay, so Domino's. These, by the way, are not buys at today's prices, in my humble opinion. They are high quality businesses and patiently waiting to own when valuation meets fundamentals. So, without spoiling, without showing you the other names, let's start with Domino's Pizza and why I love this business model and it so much. It's a franchise machine with cannibal economics, guys. I mean, in simple terms, that's what we are talking about. Domino's operates one of the best franchise business models in the world. What you have to understand is that 99% of stores are franchise owned. Why is this such a big deal? Is because the risk there, this creates a lot of consistent cash flows over time. Okay, because they earn royalties, fees, and the supply chain income. They collect those royalties, so the downside is minimal, while the upside is just exponential because people will never stop eating pizza. Yeah, I mean, it's just, look, I'm a healthy person, okay? So you can create as many healthy meals as you can, but at the end of the day, you will always have a lot of people who are willing to buy a lot of junk food. And I live in the UK, I see that all around me. It's just a reality. And so they can increase prices without sacrificing demand. That alone, that in and of itself gives them a big competitive advantage. Look at that. Revenue is recurring, high margin and predictable. The best type of margin we can aim for is recurring revenue. Okay, revenue that is it just comes. I love that. Minimal capital intensity compared to traditional retailers. Why do they have minimal capital intensity? Because of the franchise business model, right? So very good. As long as franchises sell pizza, Domino's gets paid. And why do they want to have Domino's name? Because of brand reputation. All right. So they still have quite a lot of room to expand their operations all over the world. So I love that. And now let's talk about the shareholder friendly capital allocation. Look at this. Over 40% of outstanding shares repurchased since 2010. Okay, so this makes Domino what? A cannibal stock. Each remaining share owns more of the business over time. I love investing in companies that have significantly significantly decreased the share count over time, because what that does is it increases your slice of the pie, so you own more of the company without having to put more money to work. Who doesn't love that? Okay, so let me just go back here to the fundamentals. Look at that. So you can see that stock lock gives it a 3.82 out of 5. Let's talk about, so they operate in the restaurant space. Look at these revenues. All right, look at that. So revenues since 2010 have compounded by about 8.4% per year. Okay, not our ideal 10%, but that's fine. Let's talk about the operating income. Look at this, compounded at about 10.77% over time. Look at the consistency, right? Consistency then creates predictability. And look at the diluted earnings per share. Boom, 18%. Why? Because they do a lot of buybacks. Look at the consistency right here. Okay, let's talk about the margins. Look at this, gross margin. So the average is about 33. Look how gross margin had been expanding from 2010 to about 2019. It slowly dipped, but look at that. So margins over time seem to be expanding, right? And the latest is at about 39. Very good, because they have pricing power. Let's talk, and they may be earning, they have probably, well, they've gained market share since 2010 as well. Look at the operating margin. Look at that. The medium is about 17% right now. We are above that trend, which is very, very good. Yeah, and let's look at net margin. Look at that. They now boost the highest net margin in history going back to 2010. This is fantastic, okay? And it's probably one of the reasons why Buffett bought this company as well. So not only did he buy the company, but he actually doubled down on it, which is, it goes to show how great a business model they have, okay? Let's now let's talk about the balance sheet. In fact, let me go here. And if I go here to statistics, take a look at this. So balance sheet, they have about 139.73 million in cash and equivalents. They have a significant, so they have negative net cash position, which is not something that I like, as you know, because if you look at this, if you look at the financial position, you know that I like debt to free cash flows, EBITDA, all of these things under 3. So why is a company like Domino's Pizza different? The reason for that is because they choose to have this they have throughout 2010 the net cash position, the cash position has been low because of buybacks. It's not that the company is not that the company doesn't have a lot of cash, right? If they wanted to, for example, to have a net cash position, but because they have recurring revenues and because free cash flows are very predictable, this allows them to actually buy back a lot of stock, okay, which means why the cash and cash equivalents has been lower over time, okay. But remember here, the business model here is the key, all right. Predictable revenues because of the franchise business model and because of the recurring revenues, all right. Not all businesses have this business model. That said, this is not ideal. And sure enough, if I go here, for example, what is their total debt? The total debt is about 5.5 billion. Let's have a look at the debt to net income trailing 12 months. Let's see. So they have they have total debt. Where is total debt? Right here. Bear with me 1 second. Right here. So that's about this much. So now, if we do that total debt, let's divide the total debt by the net income. And we have what? 589. So 589. Look at that. So the debt to net income is over 8, at about 9. Ideally, I want to see this under 3. Okay, so this is not something that I like to see. But look, Domino's has always had a similar balance sheet since 2010. Okay, and that's the reality. And they never stopped compounding shareholder money consistently over time because of the business model. You have to understand that. All right, that's very important. But the reason I don't like that much debt, guys, is because it may become unsustainable. I don't think Domino's is going to have that problem, of course, because of the nature of the business. But if interest payments on the debt increase due to increasing interest rates, then it may be more difficult for the company to then pay down that debt. But in the case of Domino's, what they would have to do is they would have to decrease the number of buybacks and allocate a big chunk of that free cash flow towards interest payments. And if I go here to the free cash flow and go to trailing 12 months, look at that. Free cash flow is about 631 million. Okay, so it's just what it is. So balance sheet is not ideal, but I believe again it's not a big red flag because of the nature of the business. Okay, and sure we were in a higher interest rate environment, as you know. So if I check the interest expense, you can see that the interest expense went up since 2021. Look at that. It has been range bound, and now I expect this to decline because we are moving in an environment where interest rates are poised to be lower. They are cutting interest rates, which will make the interest payments on the debt less expensive. Okay, cool. So that's a tailwind. Let's move. Oh, and by the way, so let's have a look at the income statement. A look at the diluted shares outstanding. Look at that. Since 2010, about 40%. You see, I love that. Cool. So I like that. And another thing that I also like is if the currency. Let's have a look at what. In fact, let's have a look here. So exceptional business quality, strong alignment between growth cash flows and buybacks. So I'm waiting for valuation compression, not business improvement, because the business and the thing is, the business has been improving because even though revenues have remained a bit stagnant since, and that explains why the stock has been slightly under pressure over the last few years. But look at that. If I just zoom in on this, you can see that since 2018, in fact, since 2019, revenues have only compounded by about 5%. Okay? So revenues are slowing. In fact, if I zoom in further, you can see that they've only compounded by about 3.41% since 2021. And if I show you the charts, yeah, you can see that that coincided with the peak. Since 2021, the stock crashed, then jumped, and now it crashed again in its range, like trading range bound. Okay, unfortunately, I didn't get to buy it around these levels. That was my mistake. It wasn't on my radar back then. But anyway, we will see if I get that opportunity in a down market, which I believe I will. Okay, cool. And if I go here to insiders, and if I click to only company executives, you can see that, in fact, let's go to insider transactions. I only want insider transactions. Okay, you can see that I have a lot of selling right here from company executives, from the CTO to executives, yeah, and so forth. Let me check here. Same thing here. It's not ideal, and we don't have high insider ownership either. So if I click the ownership and if I click the show only company executives, look at that. So this guy has 16 million worth of stock, and the CEO, where is he? Right here, has about 11 million. This guy has been with Domino's for many, many years, which is something that I like. He climbed up the ranks, so he knows the company inside out, which is very good. But ideally, I would want to see a higher insider ownership, but it's what it is. Okay, so this is it. This is what I wanted to say. And from a valuation standpoint, you can see from a price to free cash flow ratio, The business trades at about 22 times. Okay, and from a price to earnings ratio, we have about 20 times. By no means do I say that this is an expensive stock. It's not. So if you are so a pure quality investor would buy this company because right now you are paying a reasonable price for a high quality company. I don't want to do that. I want to buy it a great company with a big margin of safety price and pay a margin of safety price. So I have to wait for the price to come back to my levels. Okay, not yet. And they also do they yeah, you can see that they are also a dividend payment company. And look at that. Over the last 10 years, they have increased, the dividends have compounded by about 18% per year on top of the buyback yield. I mean, this is incredible. So you can see that. Look at that. Let's have a look at so let's go to statistics. Yeah, look at the shareholder yield. Shareholder yield, which includes the dividend yield plus the buyback yield, you have about 3.73. So I want to see this higher. Okay, higher. Cool. So this is the first company. Yeah. Okay. Second company, Meta Platforms. Who doesn't know Meta? Global attention monopoly with founder at the helm. Why it's so special, this company? Because Meta owns some of the most valuable real estate in human attention. Don't trust me? Just look at the metrics. Nearly 50% of the world's population uses Meta every month. That is not a typo. Platforms include Facebook, Instagram, WhatsApp, and Messenger. I use all of them, all of them. And I do understand how powerful the network effect is and how powerful the switching costs are. Okay, I don't think you will see any competitor to this business in the short to medium term at least. And because I mean it's so ingrained in our society, it's very difficult for us for competitors to actually breach their disrupt their model. And look at that, 70.7% of revenue comes from advertising powered by unmatched user data and engagement. So this is not just a social media company, it's a global advertising infrastructure. Okay, what else do I like? Mark Zuckerberg owns 13.16% of Meta. That stake is valued at approximately almost 200 billion. So we have a lot of skin in the game right here, everybody. Okay, let's explore, let's delve deeper into their financials here. This company also stands to benefit from the AI wave. You're probably asking, Ed, why didn't you buy this company after the 70% collapse in 2022? Well, because I didn't understand the business as well back then, so it just escaped. But I'm okay with that because I'm invested in great businesses, and so I don't feel any FOMO. That's one of the things that I have going for me. Okay. If I go here to the financials, let's look at total revenue since 2015 at about 27.9% per year. This has been a phenomenal compounder since to look at that 30% operating income and earnings. That's about 36.96%, staggering. And of course, diluted earnings per share 38.24%, which is also very good. What else can I say about this company, guys? If you go here to the balance sheet, you can see that again, they have a negative net cash position. So they have a lot of total, the total debt has increased substantially as of lately. If I show you here, and let me check something here. You can see no short-term debt, but this is the problem. Okay, so the long-term debt went ballistic because of the AI investments. Again, do I like that? No, I don't. And not least because for many years, Meta boosted a net cash position. All right, that's important to understand. If I go here to metrics, I'm not sure I will find that here. Uh, Look at that net debt right here. You can see Net debt is quite high. In fact, it has been high for a while. So if I go here to financials, balance sheet, let's have a look at the net. Yeah, look at this is what I wanted to show you guys. Look at that net cash. You can see that for a very long time they actually had a net cash position. In fact, until 2024. But right now, because of AI investments, they are in debt. Okay, so the question here is: do you think that the debt they have been borrowing is going to significantly unlock value over time? Okay, so do you think the AI investments will turn into profits down the line? And if that is the case, then you then of course you can it then it won't be a red flag. In my opinion, look in considering how much cash flow the company generates, and if I go here to the latest, look at that, that's 44 billion in cash. So if I show you here, so if I go here to statistics, right here, you can see that the free cash flow is about 44 billion, and you can see that the total debt is about 51 billion. So granted, the cash, they don't have a net cash position, but they could pay down almost all of the debt from current free cash flows. And sure enough, the debt to free cash flow is less under 3, and the debt to equity is well under 3, which is, and so is the debt to EBITDA. So this is all ideal. I think the company has a great in a great financial position, so that debt is not worrisome because of that. Okay, look, they are investing in AI. They know they have to do it in order to be at the forefront of innovation, and I do think that that will unlock value. And it helps a lot when you have a founder-led business, right? And whose CEO is still the founder. So if I show you the ownership, show only company executives, look at that. Mark Zuckerberg, look at that. Absolutely amazing. Okay, so owner operator, very good, and stock unlock gives it a very high score. Let's go here and see the they because they are a tech company. What does the share exactly? So this is what I don't like. If I go here to management, you can see that the share-based compensation as a percentage of revenue sits at about 10%. It's not, look, but the problem is when you go to operating cash flows, that's about 17%. And of course, if you look at free cash flows, that's about 41.92%. That's high, but they are doing, don't focus too much on this because they are using a lot of those free cash flows to invest, but focus on operating cash flows. This is quite high, but it's common among tech businesses. Okay, and it's been like that for a while. As long as they continue to improve shareholder value, that's not worrisome to me. Okay, and so the problem right now is that you are paying a hefty price for this quality compounder. Okay, that's the price to free cash flow is about 37. The PE is about 22. They've come down recently, but look at that's the forward PE, by the way. The current PE is about 28. So not ideal. Typically, I would like to see this cheaper. So it's definitely a pass for now, but it has been a stellar compounder over time. Okay, cool. And again, if I go here and check the margins, look at that. Look at the consistency of the margins. Let's check operating margin. Look at that. The average is about 40. Right now we are at 42, increasing since 2022. So we have margin expansion here. We have operational operating leverage. Okay, and if I go to net margin since 2022, look where we are right now. The average is about 31. Right now we have 37. Great business. Okay, awesome. Let's talk about what are insiders doing right now. Show only company executives. You can see that you can see insider transactions. You can see that there has been a ton of selling, and this is the problem. And this is a common theme across all these tech companies from Meta to Amazon to Nvidia, the insiders have been selling a lot because, in my opinion, they know the stock is expensive. Okay, so they are selling to the unaware retail investors. So yeah, let's go to the next company, and that is MSCI Inc. I don't know if many of you know this company. This company has been a terrific compounder as well over time. So let me just delve deeper into the fundamentals right here. So this is one of the highest quality data businesses on earth. Why do I think this company is special? Again, look at the revenue, look at the recurring revenue. 97% of revenue is recurring. It's my preferred type of revenue. The company is a quiet compounder with exceptional economics. Core products include indexes, analytics, and risk tools embedded into institutional workflows. Customers don't churn because switching costs are enormous. This is a toll road on global capital markets. Look at the long-term performance, guys. Since 2009, the company has delivered 20% annual returns. Just let that sink in. 10,000 invested in 2009 would have turned into $120,000 today. Okay? 30% of shares repurchased since 2010. So what do we have? We have a company that is, in my opinion, is a cannibal stock, aggressively buying back shares. We have a company that has a lot of recurring revenue. Most of it, the revenue is recurring in nature, and we have a company with a strong moat. All right, and more importantly as well, look at that. Hernan Fernandez has been CEO and chairman since 1998. So we have a long tenure here. I love that. And he owns 2.77% of the business, and that stake is worth almost 1 billion. This is a rare combination of longevity, which I love, ownership, and execution. Why is it on my watch list? Elite business quality, extreme revenue visibility, waiting for the market to offer a margin of safety. And this is where you guys tell me, oh, Ed, but this companies like that will never be that cheap. That is not the case. Never, never believe that. What it means is that you have to be more patient. And sure enough, look at that. Despite the company being so great, that didn't stop the company from falling from 675 all the way down to 416, right? It was 386 in 2022. Remember, even great companies go through periods of uncertainty, and that includes every single company that I'm currently invested in. Okay, so try. I'm just sharing my playbook with you. Okay, so be patient. And sure enough, look at this. If I show you the margins, let's show you the margins. Look at that. 80% has been the average, latest 80, almost 89, 82%. Look at the consistency. It barely moved since 2015. Look at the operating margin again. So what you can see is that operating margin, the average is 48. Right now we are at 53. And look how operating margin has been slightly but consistently expanding over time. Okay, there has been a slight dip right here. In fact, if I zoom in on this further, but you can see the dip right here. But now we have been upticking again. Okay, you look at the net margin. What do we have right here? Look at that. On a yearly basis, you see improving margins. So this company is getting more efficient over time. And I love that because this is what you want to see as the company becomes more mature. And if I go here to the free cash flows, in fact, let's have a look at their statistics, what we have right here. So again, this is very interesting. You can see that across these three great businesses, they all have a negative cash position. So and it doesn't make them less great because of that negative net cash position. And the reason for that, as I told you, is because many of them choose to be in that position. They have a lot of growth of potential. They choose, and because of the predictability of the cash flows, they choose to use a lot of the cash position and free cash flows to reinvest back into the business, which can give the impression of a less healthy balance sheet, but you have to understand the business. Okay, so I hope I managed to drive that point, to drive this home. And sure enough, look at the debt to free cash flow under 4, debt to EBIT about under 3, and the interest coverage is about 9, which is very good. It means the interest payments on the debt are well covered by the company's operating income. Okay, so more also equally important, guys, something that I forgot to mention: look at Royce. How could I possibly miss Royce across these names? Royce is the most important metric because it tells you how efficiently management turns invested capital into net operating profit after net operating profit. Sorry, you can see that if I go here to metrics, okay, financials, let's go here to ratios, look at annual, look at Royce, look at that. So the returns on capital, sorry, excuse me, yeah, the returns on invested capital have been improving since 2020. Fantastic, okay, fantastic. Let's now have a look at the other two that I completely forgot to discuss. So we have Domino's Pizza. Let's have a look at the company's Royce. Yeah, look at that. So Royce, 50.35%. I mean, what else can I say? Yeah, what else can I say, guys? Absolutely incredible. This is absolutely incredible. This company generates ridiculous returns on invested capital, and more importantly, they have been expanding from the most recent bottom set in 2023. So fantastic. And last but not least, let's have a look at Meta. And in the case of Meta, because they have been taking on debt, and because of the investments, the high capex, right, in towards data centers and all of the AI investments, I believe Royce has been coming down. Okay, let's have a look to see if this confirms what I'm saying. Actually, not. Look at that. It declined from 2021 to 2022, but it has been going up sharply. So in 2022 we had about 14.41. Right now we are at 22%. So they continue to generate high returns on invested capital despite the aggressive investments. That's incredible. I mean, this is just a great business, and so yeah, it's what it is. So guys, I just show you these are the 3 companies I would love to buy in the next downturn, provided the fundamentals, provided the story still stands when that happens. Okay, and I believe it will. So if you like this, guys, please smash the like button, and don't forget that we have our live YouTube live event coming up at the end of the month. So make sure you share. I left one of the posts highlighting this, but make sure you tell me which companies you'd like me to delve deeper into, and I would gladly do that. Enjoy. Have a great rest of your day.